Good afternoon and a very warm welcome to all of you at our yet another webinar on UAE Corporate Tax. Many of you who are following us might be aware that we have been conducting series of webinars and events following this very important development in UAE called corporate tax law. Today we have picked up yet another important topic of the law which is relevant for almost all different types of business and industry and can potentially have significant impact on your tax liability as well. Transition of UAE from a no corporate tax jurisdiction to a low corporate tax jurisdiction is indeed not an easy one. And there are certain situations which are very unique to the so-called transition period. Fortunately, the authorities have identified a number of such transitional situations or challenges and defined rules of the game through series of ministerial decisions. Have you ever thought what will happen to your assets which are held at cost or at some historic value in your balance sheet when the law comes into effect? Particularly when market value of such asset is very different today compared to their book value. Suppose if you sell such assets in 2024 or 2025, when the CT is applicable on your business, what will happen? Do you get taxed at gain in value that happens before the CT law comes into effect? Or can you bring them at fair value before entering into the corporate tax era for your business? Fortunately, we have a decision which is Ministerial Decision 120 issued by Ministry of Finance, which defines the rules of such situation. And my very young and bright colleagues, CA Pratik and CA Karishma, will go through this particular ministerial decision in detail today and will hopefully clarify most of your queries in this regard. Over to you, Pratik.
Thank you, Sheetal sir, and a very warm welcome to everyone who's been part of this webinars that MI Capital keeps on doing for the knowledge sharing purpose as well as awareness that we want to create. So as mentioned by sir, this webinar is specifically for the assets that are there in the books of accounts that can be revalued, and you can probably take few benefits out of the same. What does the same means when it comes to law, and what is the cabinet decision that are being published? I will cover in brief, and then we will have few examples by my colleague Karishma. So Article 61, which is the transitional rule, says that when you form the closing balance sheet before the tax period, you may get a benefit of revaluing the assets as that is held, and what is the benefits, which assets will get the benefit of claiming the loss or gain, and how you can utilize it. We will cover in the examples below, but it applies before the tax period, and it has to be opted when we file the first return. So moving ahead, what are the benefits that are covered, and what are few benefits which will be available to all the companies will be covered in the next slide. Definitely, the tax, if you assume an example, say your asset is $1 million on the historic cost, but today if you find the present value, it is $2 million. So if you sell the asset in the next year at $2 million, there will be a capital gains at $1 million. So just to avoid that capital gains and to get the benefit of historic value to the fair value, before your first tax period, you can probably revalue the assets to 1.8 or 1.9, whatever is certified valued by the certified valuer, and you can take that benefit. Financial statements do not have to be reinstated. What that mean? That the value of the asset in the books of accounts will be $1 million. The only thing we'll have to do is opt that we will be taking the benefit of valuation at fair value while filing the tax return. The election is compulsory with the filing of return. You will not get additional depreciation, and this is very critical. What do I mean by additional depreciation? So when I revalue the asset, it becomes higher than the previous value, right? So if I revalue the assets, that's fine. You can claim the capital gains benefit out of it. But that revalued asset, the depreciation will still be at the earlier method or the earlier value that has been classified in the books of accounts. What is very important to note that the ministry has clarified that this will be applicable for three classes, which is immovable properties, financial assets, and intangible assets. And it is not applicable to any other class. Now, for an example, if you have a vintage car, right, in that case, will you get the benefit of revaluation is something that is food for thought. But we are very clear that this applies to three classes, that is immovable property, intangible assets. Immovable property can be land building, intangible assets are softwares, patents, and financial assets, that is current assets, stocks, debentures. On all of that, you can value the assets, adjust the gains and losses depending on the scenarios, and it can help you in finally, once you submit the final return for your first tax period, it'll be helping you in terms of getting the benefits. So over to you, Karishma, for enlightening with an example how we can cover the movable properties, intangible assets, as well as the financial assets.
Sure. Thank you so much, sir. So now I would just want to quickly highlight, as mentioned by Pratik sir, that there are only three class of assets that is being specified that you can revalue or you revalue for. They are the immovable property, the intangible assets, and the financial assets and liabilities. Now, the ministry decision has specified that if you are owning these assets, then they have to qualify to be part of that immovable property or the assets, the intangible assets, or as per the financial assets. So they have first classified. Let me first walk you through for the immovable property. So it has been stated that an immovable property will be treated as a qualifying immovable property if it is owned prior to first tax period. It is measured and recorded at an historical cost basis in the financial statements, and it is deemed or disposed or deemed to be disposed of during the first tax period or after the first tax period for profits. So if these three conditions are satisfied, then any immovable property which is there in your financial statements will be treated as a qualifying immovable property. And if that is satisfied, then gains or profits that are arising on disposal of these qualifying immovable property can be excluded from the capital gain or while calculating your taxable income for the corporate tax purpose. Now, what is the amount of gain that you have to reduce or you have to deduct from your taxable income? There are two options which are given for the immovable property. It says that under option 1, the gains that you can exclude needs to be calculated directly at market value reduced by the cost or the net book value, whichever is higher. So whatever amount that is being left out, that will be the gains that you can deduct from your taxable income. There is another option that is given for the immovable property in which it says that whatever sale proceeds you will have when you are disposing of that qualifying immovable property reduced by your cost or net book value, whichever is higher, that needs to be multiplied by the number of days the asset is owned prior to the first tax period divided by total number of days the immovable property is being held by you. So multiplication of these proceeds minus your cost and book value multiplied by the number of days the asset was held by you prior to the pre-tax period, that part of the gain you can reduce from your taxable income. Now, this calculation, like how these can be calculated, I'll explain in an example that is being taken further. Before that, there are some additional conditions that you have to fulfill to make these adjustments to your immovable property. Now, the adjustment, as being mentioned earlier as well by Mr. Pratik, that you have to adjust the taxable income only upon election, and that election that you are classifying your immovable property or you are electing to opt or exclude these profits have to be made in your first return, in your first corporate tax return that you will be submitting. You just have to make an election and notify to the authorities that you are going for these options. And secondly, the election is to be made for each qualifying immovable property. If you have a separate class of immovable property, of course, you have to make an election for each qualifying immovable property separately. And once the election is being made in your first corporate tax return, you cannot withdraw it unless there are certain exceptional cases based on which the authorities may allow you to revoke your election that is already being made. The third important condition for making the adjustment is about the market value. Now, the law states that you have to market your immovable property at market value. Now, what is the market value? That is to be determined by the relevant government authority. So far, what will be the government authority or who will be the valuer, that has not yet been specified, but we are expecting that definitely they would come out with a list of government authorized valuers who would value your immovable property and state you the exact value of the properties held by you. And the most important condition for this adjustment is, now as you are you might be aware that you can form a group or tax group or a qualifying group. So certain class of assets can be part of your qualifying group as well as your tax group. So ownership or whatever the assets are being held by a group as a whole will also be calculated, will also be considered while calculating the gains or profits on sale of these immovable properties. So let me quickly go through or explain you like how these two methods of calculating the gains will be derived. The first method, which states that you have to reduce your market value by cost, by higher of cost or net book value, and the second one is by the based on the number of days. So the first
So Karishma,
yes sir.
Karishma, can I quickly ask you a question here?
Sure.
For every asset which is immovable property, can I opt for option one or option two differently? Or do we have to choose one option for all the assets that are in that
No,
category?
the option is at your discretion. You can choose either option one or either option two. It's not that for
For every
each
different
property.
asset.
Yes, every
Okay.
qualifying immovable property you can choose. Like say for you have one asset, say a building, you can go for option one. Or if you have another plant and machinery, you can go for option two. It's not that it's applicable on an entire asset as a whole. Every immovable property separately you have to define, and you can go with whatever option that you want, one or two.
Okay. Thank you.
Shall I move forward?
Yeah, please.
Yeah, so the option one, which says that you have to first, and under option one, the very simple first cases, let me first explain this one. Like say if ABC company has a property and equipment that was purchased on 1st Jan 2020 for 6 million, and it has an estimated useful life of say 20 years, and the company wishes or is probably expecting to sell the same property for 20 million in the year 2026. So as stated in the earlier exam, in the prior slide, that it is to be disposed or deemed to be disposed of during or after the first tax period. Now, assuming that the company is going to dispose of the property and equipment that is being held by in the year 2026 for 20 million. So what will be the gains that they have to exclude from their taxable income? That is the calculation. So firstly, we have to calculate the net book value as on the end of the first tax prior to first tax period. In such case, if we assume that they have Jan to December as their financial period, we'll calculate the WDV as on 31st December 2023, which comes in this case as 4.8 million. Then we have to calculate the gains that we need to exclude from the taxable income that will be calculated in the year 2026. So that will be the market value, which is derived as on 31st December 2023, that is 12 million, which is to be derived by a market value. Then reduce the cost or net book value, whichever is higher. In such case, the cost in this case is 6 million, while the WDV is 4.8 million. That's why we'll reduce 6 million, and we get an estimated gain that we need to reduce from our corporate tax calculation that will be done in the year 2026. After that, we will calculate the WDV as on the year end when we are actually going to sell the property. So WDV, which is derived as on 31st December 2023, reducing the depreciation for 3 years. The WDV as on the date when we are actually selling the property is 3.9 million. The property as ready, the sell price to 20 million, which will be reduced by the WDV, gain on property that is derived as 16.1 million, and the estimated gains as we calculated in the step 2, that is 6 million. It will be reduced from the actual gains that we are deriving from the sale of the property, and then the only capital gains or the only profits that will be taxable is 10.1 million. So in this way, you can reduce your tax, you can adjust your taxable income by 6 million and thus get a benefit of taxation on this 6 million of profits, 6 million of gains for the prior period that we had held the asset for. Similar way as the in the option 2, it states that you have to revalue, you have to apportionate your capital gain for the pre-tax period and the post-tax period. So in this case, as you can see, for the pre-tax period, the asset is hold for 1460 divided by total number of days, that is 2555. The ratio comes to somewhere 57.14%. So for the gain for pre-tax period is 8 million. Now, this 8 million of the gain for pre-tax period, you can reduce from your corporate tax liability, and thus the only profits or the capital gains that will be liable for corporate tax will be 8.1 million. So this is just an example to give you an idea like how the...
No,
Sorry.
Karishma, so the question
Yes.
is, you
Yes, sir.
don't, if suppose somebody doesn't want to go to the hassle of revaluing the asset, then option 2 is the, is one of the option that is given, right? In this case, the revaluation is not required.
Yes, in this case, the revaluation not required. In this case, straightforward, you just need to divide your profits for pre-tax and post-tax, and the pre-tax period straight away gets deducted from your gains that you are calculating.
Got you. Perfect.
Okay, so similar way as now this was for the immovable property. For immovable property, we have a choice to make in option 1 or option 2. Whatever is more viable or more suitable for the company, accordingly they can choose, make a decision, and based on that, they can calculate their tax liability. The second important aspect which states about the intangible assets. So if an intangible asset is owned prior to first tax period, it is measured on historical cost, and same way it is also disposed or deemed to be disposed of during the first tax period. Then whatever gains that are being derived, that needs to be that can be excluded from the taxable income for each of the qualifying intangible assets. So for intangible assets, it's a very straightforward, just one method, that you need to directly multiply your gains, whatever gains you are deriving after sale proceeds that is being reduced by your higher of your cost or net book value, and multiply it by the number of days it was owned prior to the first tax period. So that's the only one method which is available for intangible assets. But here there is one additional condition, that the total number of years the intangible asset was is held, or it is to be held, is capped only up to 10 years. Suppose if you have purchased it for the company is since in existence for say 2010, then it already crossed 23 years. So definitely they won't get this benefit. It has to be restricted only up to 10 years. You cannot claim for entire 13 years your calculation of the intangible assets. And the same conditions repeat. Adjustment has to be made in your taxable income based on the election in the first tax period you are going to make. The ownership of the qualifying groups and tax groups will also be considered. And yeah, so these are the main conditions for the adjustments for revaluation of intangible assets that you need to consider. And lastly comes about the adjustment
so for intangible asset, Karishma, there is option 1 doesn't exist, only option 2.
Yeah, there's just one option. There's no option as such. There's just one calculation that is being given, that this is the only way that you need to revalue, or you can reduce your gains or profits from the taxable income.
Got you.
And lastly comes about the financial assets and liabilities. There are only two conditions for financial assets and liabilities, stating that it is owned prior to your first tax period and it is measured on historical cost basis. If these two conditions are satisfied, then your financial assets or liabilities will be treated as a qualifying financial assets and liabilities, and you can exclude the gains or losses that are being derived upon the revaluation, and the value will be directly the market value reduced by cost, which needs to be equal to the net book value. That is what is being stated in the ministerial decisions. So if these conditions are satisfied, you can directly exclude the gains that has been derived from your taxable income whenever you are selling or whenever you are disposing of your assets and liabilities. So the main point to be noted in all these adjustments that are being given for the immovable property or for the intangible assets or for financial assets and liabilities is it is to be measured at historical cost basis. So if the company has been measuring it on the fair value basis, or the company has been every year revaluing or mark to market value, if they are being revaluing their assets or liabilities in the books of accounts, this ministerial decision is not beneficial for those kind of or those class of assets. Only if the books are being continued to be maintained on the historical cost basis, then you can avail or you would be eligible to claim this benefit of the decision. So yeah, these were the major highlights given for all the class of assets that is being given in the decisions, stating that you can revalue your assets and liabilities and make an election in your first tax return and thus claim the benefits. Uh, we will love to have few question answers if you have from your end to answer those, and would be happy to help assist on those one.
Yeah, thank you, Karishma. Thank you. I'll encourage the participants to throw up the questions. We'll try to address these questions. But I have a couple of things. I mean, I'll want to ask one question here. It only covers these three categories, right? Immovable
Correct.
properties. The second is intangible assets, and the third is financial assets.
Financial
Yes. Yes.
What if some of my assets which are not falling in three categories and being valued at cost? I mean, for example, I have a car, right, which is a movable property and not falling under immovable, not falling under financial assets, not falling under intangible asset as well. Is there any clarity in this, in this ministerial decision for something like this?
No. They have very clearly specified that this will be applicable only on these three class of assets. Other than that, if your asset is being falling, then definitely it won't fall under this category and they won't be able to take the benefit. So there's no treatment as such which is being given for those class of assets.
Okay, interesting. So if it is not falling under any of these three categories, you cannot take the benefit of this particular transitional provision.
Yes.
So there's a question, Karishma. Can you
Yes, sir.
please explain the 10-year exception for intangible that we covered?
Yes. So for intangible assets, it is being, I think it's been asked by Mr.
GC Jain Saab.
Gautam.
Okay,
Yeah.
okay, yes, sir. So it's stated that for intangible assets, even if your assets are being purchased for more than 15 years or more than 10 years, for more than 10 years, then it is capped up to 10 years. So if for 13 years you are holding the assets, the valuation, I'll just quickly go on that slide so that it will give you an idea. So it says that while calculating the number of days owned prior to first tax period divided by total number of days the intangible assets are being owned, while calculating this number, you have to restrict it only up to 10 years. So the number of days, it cannot be more than 10 years. If it's been going more than 10 years, then you have to keep the calculation is to be restricted only for the 10 years. The calculation as we did in this year, it says it was whole like for more, in this case, definitely it was a lesser year. In this, the calculation, while calculating it, it will be only for the 10 years. I hope that
So
that clears it.
Yeah. I think just to oversimplify it,
Yeah.
instead of days, if we assume days, right?
Yes.
Then if it is sold in say 2025, so 1 year post tax period, correct?
Correct.
And
9 years
13 years pre-tax period, say 2010 we bought it. Then effectively the calculation will be 1 divided by 10 rather than 1 divided by 30.
By 40. Yeah, correct.
Okay.
Correct.
Okay.
Right.
Hope that clarifies, GC Saab. Going ahead, I think Rishabh has one more question. And it's, I think, Karishma, it's very straightforward. But what would be the tax case if the land has been recorded at book value, which is very low as compared to the market value, and he's no mood in selling right now? But say
Okay.
after 5 years, if he wishes to sell the property, do we have to revalue the land now and show it in my first tax return?
So I'll just clear this out so that you don't have to revalue or you don't have to restate anywhere your financial assets or your financial statements. It's just that you have to elect and let them know that we are going for this this provision, and whenever you are selling, as mentioned in this case as well, it says that it's disposed or deemed to be disposed of. It's not that you definitely have to dispose it of. If you are assuming, okay, you have to sell it in the year 2025, or say 10 years down the line, or say 5 years down the line, depending on your criteria, you just have to make an election in the first tax period that we would go for this option. Now, what will be the method or what details needs to be provided, that is not yet being clarified by the authorities. It just says that you have to elect for this option. If you elect, then your calculation will be based on all these decisions, and if you don't elect, then your normal calculation will be carried forward. So
So
that's I hope it
straightforward election
clarifies.
has to be made.
Correct.
Yeah, election has to be made. That's the straightforward thing, and it has to be made in the first tax return.
Right.
And
Uh,
particularly when it is immovable property, then you need to, if suppose you elect for option one, which is fair valuing the property, then you need to conduct that fair valuation through an author, through a approved, minister,
Valuer. Correct.
valuer,
Right.
which they have not yet clarified who will be the approved valuer,
Correct.
particularly on immovable properties.
Correct. So going forward, because there are some interesting questions as I can see, treatment of goodwill again by GC Saab, but treatment of goodwill. It's an intangible asset, so it should have the same treatment. But over to you, Karishma. What do you feel?
Yeah, I think that's what again, it will be the same treatment as given for the intangible assets, that you have to just elect and show proof just elect and show to the authorities that you are going for this option. And once you have elected, whenever the goodwill is revalued, or whenever you are disposing of, or whenever the business is being transferred, at that time the goodwill valuation as on the last day of your first tax period till you are selling, the same calculation will continue. But again, it will be restricted up to 10 years, as it is coming into intangible assets.
This is interesting, eh? From Savita. Can a election be made for a building constructed on leasehold land? See, leasehold land, anything that you construct on leasehold land, I think you need to classify in balance sheet as leasehold improvements. It is a immovable
Correct.
property that you can record in your balance sheet. And once it is under immovable properties, we believe, I think they still need to clarify. I think that definition of immovable
Right.
properties is not yet out.
Correct.
But
Correct.
assuming, it is part of the immovable properties, then you should be able to, take the benefit of option one or option two on this particular asset as well.
Correct. So, sir, to take few more questions, because I think the audience is very active, which is very good.
Excellent. Yeah.
Ram has asked a question, and it is very interesting again, because we talked about cars, right? And he said that any car leasing or rental company having 1,000 cars, can they enjoy this transitional benefit as movable, or it will differ as these are used for primary for revenue generation?
See, I mean, what it is not applicable. First and foremost, car is a very simple question to start with, because it is an immovable. It is not an
Movable
immovable
property.
property. It is a movable
Correct.
property, right? So it's so far what it looks from the plain reading of the ministerial decision is concerned. It does not give any benefit to non-immovable properties, or rather, I would call it movable properties. So suppose if it was something else, say machine rental company or whatever, I mean, then the answer probably would have been, we'll have to think about the answer if it was something else. But for car, it is very clear that, it does not get covered into these benefits that we get.
So, yeah, I hope that question has got answered, Ram. Unfortunately, it's not in your favor, but yeah, that's how the law is currently. From Rao Saab, what is the treatment of land held by sale by
Enforcement.
real estate companies as current assets and not as PPEs? So here the trigger of financial assets will come into picture. So yes.
No, I think it is it. We have to wait and watch the definition of immovable properties in order to answer this. But in my view, it should be considered as immovable properties.
Correct.
It should be considered as immovable property. Again, the definition will clarify this, but and potentially can get the benefit of uh, of this transition provision.
Correct. So moving on, Pawan has asked, how can we get the market value? I think it has to be from a registered valuer, but yeah, over to you, sir.
See, you have to see two things because they have differentiated between immovable properties valuation vis-a-vis financial asset valuation. Financial asset valuation, they are not, the ministerial decision does not give any clarity at all. Apparently, they are assuming that financial asset the market value is readily available. Although there might be some exceptions, like if I am holding some private shares of a private company, I mean, the valuation, I need to commission the valuation in order to get to know the value of my, privately held shares. But if it's a publicly traded equity, publicly traded bond, all of these things, the rates might, must be available readily, right? But when it comes to immovable properties, the valuation has to be done by some approved valuer. I think the language in the law is very clear. Karishma, if you can read that, and they will come back to us. They will clarify in separate decisions who are the approved valuers to do valuation of these assets, particularly
Correct.
immovable properties.
Right, sir.
Correct. And I don't know, moving on, but there's this finance manager. The point he's making is, I think there is no provision required, only election option should be made. So yeah, you're correct that provision is not required. There has to be an election.
I think
And the
so.
next
Prior
question
to
is,
that, GC Jensen has just mentioned that will there be any DT or DTL provision required?
DTL
So
provisions.
post for that, definitely there's no provision. It's just an election, the first written that is required. No changes or no adjustments as of now would be required in the books.
Correct.
Moving to Eileen, what would be the effect of the election in the books?
No change.
So,
that's what I
correct.
said
There
right
is
now.
there is
No
change.
change in the books. Your books will continue to remain based on the provisions or based on the principles that you're following. It's just on your written, there would be just one tick mark probably that they would ask you to submit, and that's it. Your books will continue. Whenever there will be disposal, at that time, all these provisions will be applicable, and in that time, the calculation will be coming into effect.
Correct. There is one more question.
Fortunately, tax authorities are not getting into the territory of accountants and auditors.
Correct.
By asking for adjustment in the books of accounts.
Correct. I think from Jaya Jadhav, the question is, please explain for lease property revaluation and ROU. That's what she's asked.
It can be done. I mean, as long as leasehold properties there are being classified, there as leasehold improvements are there, which is being classified under immovable properties. There is, I mean, it gets into the first part and you get two options. One is, to revalue in your first tax period, or the option two is to the pro rata benefit that you can get for the period that you held before the tax law came into effect. So there's no separate treatment for leasehold asset vis-a-vis freehold assets or whatever. I think what the law talks about is immovable properties, whether with leasehold rights or freehold rights.
Correct. I think those were the questions in the chat box, Karishma. We've got one more from Ashwini Mehra. What is the status of investment property valued in books at MTA?
So just to clarify, Ashwini, as I told earlier as well, in the last point as well, that it is very clearly mentioned that only if the property are being valued at historical cost and they are continuing on a historical cost basis, then only you would be able to take this benefit. With respect to the status of immovable property, investment property that is being valued at mark to market, there's another provision, maybe that will just give a clarity for your question, that it states that you can continue to revalue those at mark to market and claim the realization or unrealized gains or losses benefit on that based on the mark to market. But at cost, if you're valuing, then you don't get into the nitty gritty or into the complexity of this decision.
No, but my question again on this is that why,
Yes.
what will you value it at? Right? See, we are at disadvantage when it is valued at cost and the value has significantly increased. If it is already being valued at fair
Right.
value,
Correct.
then I think
Then no benefit, then there wouldn't be as such benefit for those fair value thing, because definitely all it as it is revalued, you are paying only on the differential amount, the taxation. It's only for historical cost. You can reinstate, you can change, reinstate your financials and then claim only on the additional benefit that you're having.
Yeah, no need to elect. Ashwini, you are correct. I mean, so no need to elect.
Yeah.
For sure. If there are no other assets, that is. So there is a question from Shavita that says that one of the conditions in the law or the ministry decision is the immovable property is qualifying if it is disposed or deemed to be disposed during or after the first tax period. Will the leasehold improvement satisfy this condition? So I think Sheetal sir briefly covered it, but yeah, it should ideally cover the improvement as well as, and you should get the benefit. So Sheetal sir, I hope that is in line with our understanding as well, and you will get the benefit. If you wish to add anything, up to you, Sheetal sir.
no, I think yeah, most likely in our view, and we wish for that it will be considered as immovable properties. But the fine definition of immovable properties we should wait, and that is yet to come.
Yeah. So interesting question by Akash. A building purchased in year 2000 for AED 10 million is fully depreciated by year 2023. Life was 20 years. The market value is AED 30 million as on 31st December 2023. And suppose sold for 30 million in January 2024. Still tax to be paid on AED 10 million as per the calculation. So he's saying, I don't know. I mean, he's saying that building has been fully depreciated, right? That's what he's saying.
20.
No, if you value the property, you have an option to value the property at 30 million. So and the property is being sold at 30 million. So there will be no tax liability on this, in my view. What do you say, Karishma?
So in this case, as if we can see this example, if we try to put
Okay.
Mr. Akash's example into
Akash's.
this case, so it says that the cost over here, instead of 6 million, if we consider as 10 million,
10.
depreciation till date, the value over here will be 0. Now, while calculating the gains to be excluded, it says that market value minus the cost or net book value, whichever is higher. So 30 million, that is the market value which is deriving, minus it will be the cost, that is 10 million. So 20 million is the estimated gain, which says that is the actual gain that they are having. So in this case, it very clearly it comes into picture that 20 million is the total gain that they are having, and that can be completely deducted while whenever they are having the gain. So in this case, it will come as again your 30 minus 10, 20 million estimated gains, that is for the pre-tax period or for this period, total it will be deducted and there wouldn't be any tax in this case.
There wouldn't be any tax in this
case. Yes. If we go with option 1, if we go with option 2, then definitely there will be some calculations and again that we have to do that, like from 2000 till 23, we have to bifurcate that and then we calculate.
Yeah.
I hope that clarifies the Akash for you.
Perfect. Any other point? Very interesting questions today.
He's saying net book value is nil in step 4. So I think, Akash, if I have to correct
There
your
is another.
question, if I have to correct Akash question, and I think our understanding, Karishma, what I understand, and Akash may top it up on the chat. He's saying his property has been depreciated, so the net book
Correct.
value is zero when
Correct.
it is
Correct.
31st December 2023, right?
Right.
So
Right.
he's saying in step 4, the sale price is 30 million. The
Correct.
net book value is zero. So
But
there is a gain of 30 million,
correct. We have to deduct the
right?
cost or the net book value, whichever is higher. So as cost is 10 million, 30 minus 10, that will be 20 million is the profit, the gain that he having. And while calculating the taxable gain for the year, whenever he's selling in the year 2024 or 2025, this entire amount will be deducted from that case. So there's no tax on that amount.
Correct. I hope Akash is getting that point, because he's confusing it only with step 4. So
Yeah.
Akash, if you follow the entire step 2, you will get the benefit of 30 million, and
Correct.
hence, there'll be no tax liability.
Correct.
So coming to Shavita's question, uh, if in option 1, then gain as per books will be 30 million as fully depreciated, and excluded gains 20 million. So 10 million will be taxable, right? She's asking.
No, I think that is what I explained right now, Savita. There won't be any tax in this case. There won't be any tax liability coming on the company.
Now, there is one interesting
so-
question here.
Yes.
Any instance of revaluing liabilities, since the topic for session also include liabilities. So
Yeah.
So it
yes,
considers financial
Yes, absolutely.
liabilities.
yeah,
Financial
it
liabilities can be revalued. Yes.
correct. Financial liabilities can be revalued,
Correct.
but there is nothing called intangible liabilities or immovable liabilities. There's only financial
Correct.
liabilities.
Right.
Yeah.
Correct. There's one more question by Amit. He says investments in insurance policy of a shareholder bought under company name. I don't know. I mean,
Sorry, I didn't get
he
this
means
question.
that
Investments in insurance
insurance policy. Yeah.
of shareholder bought under company name.
I mean, I think he's asking whether
It's
we
a
can
financial
revalue. I don't know.
asset. It is a
Correct.
financial asset, and it has to be valued at market value.
Correct.
So investment in insurance policy is a financial asset probably, and it falls under the third option, and the only option in that case is revaluing at fair value for the first tax period, before the first tax period, for the tax return purpose. Yeah, whatever the fair value principles you need to apply. So, I mean, depending upon fair value principles, you have to apply. And if the surrender value is considered as a fair value, yes. Any other point?
Not really.
Perfect. I think it was a very interesting session. And no further
Sir, I
questions.
would want to ask a question.
Please.
I would really want to, because there is one question that I feel is very important. I think there is one couple of more questions. Sorry. Vaishnavi, this side, what can be the case when NBV will be higher than the cost? Okay, what will be the case if the net book value is higher than the cost? Is the question.
So while calculating straightforward,
Very
it's
rare
higher.
situation.
Yeah.
Very
Very
rare
it
situation.
might
I
happen.
cannot think of a situation when NBV will be higher than the cost.
Unless and until you're revaluing. And if you're
Exactly.
revaluing, then definitely you lose this benefit. It must always be the same thing.
In the aforesaid example, 30 million, in either of the option, the taxable income would be 10 million. Please recheck. I don't know. I mean, I'm sure we will be, we'll take this example live, I think, Karishma, and produce this in the second illustration.
Is option 2 as per ministerial decision 120? Yes. Option 2
Yes.
is as per the ministerial
But
decision.
only
The
for
two options on.
immovable properties.
Correct.
Pratik, you had a question, please.
Yeah. So I just had like a lot of people have car in mind. There are a lot of balance sheets that I have seen that has high value paintings and high value vintage furnitures that are there in the books, uh, which are which are technically kept always. So to my understanding, and this is what I would love to know, whether can we revalue that, because only three kinds are covered: immovable, intangible, and financial assets. So what do you feel, Karishma, for high value paintings and all such other vintage options?
So unfortunately, that won't be covered in this case. You definitely wouldn't be able to take the benefit of the revaluation or claim the excess or claim the capital gains on that part. You that will stay intact. The whatever the value is being considering in your book, that will stay at that value, and you cannot claim the benefit of this decision. So no revaluation or no additional or no capital gain will be reduced in that case. It will uh, continue at the
But
same basis.
for a
Yeah.
painter, it can be a stock, right, which can be in the financial assets, and then he can value it.
Yes, if that's the case. But if it is, it depends. That will also depend. If it comes under the financial assets, then definitely they can revalue and that will be considered.
Okay, there's one
In
good
some,
question, and
yes,
this
yes.
probably will take this as a last question. Uh, uh, Firoz is asking, sorry, this is not regarding this topic, but want to know the last date of registering for corporate tax for small companies which do not qualify for payment of corporate tax. So
There
whether
is
you are, whether you have any tax liability or not, first and foremost, this is a fundamental point that every company, unlike VAT, in case of VAT, there was voluntary registration, there was mandatory registration above certain threshold of revenue. In case of corporate tax, everyone has to register. Every single company has to register. There is no deadline which has been prescribed yet, particularly on the CT registration. So there's no deadline as such, but yes, you need to register for it before filing the first tax return. Correct. Date has not defined yet. Somebody is answering from the webinar. Well, I think we'll close this webinar now. I'm really glad that a lot of people have participated in this webinar. Thank you for this participation. We will continue with our series of webinars, picking up certain important topics, topic by topic, on corporate tax law. And we hope to see you. Feel free to reach out to us at any point of time. We will drop you a note. And for any clarifications, if you have been able to ask during the course of the webinar, even if you have not been able to ask, happy to answer the queries. You can write to us one-to-one, and then we will be glad to come back to you with our opinion and answer on that. So thank you yet again. Look forward to see you soon.
Thank you.
Thank you. Bye bye.
Thank you so much, everyone. Thank you. Bye bye.